Yo,
Ethan,
what's up, man? How are you doing?
uh, you hear me okay?
Yeah. Is LC Rogers with us too? What's up going on, man?
What's up?
If you
What's
can
up?
hear me.
What is up?
Not
Um,
much.
let's alert to everybody that we are now live.
Yes, sir.
Um, we are live. Okay, so let's maybe give it 1 to 60 seconds here.
Yeah.
See if anybody wants to tune in here. Let's kind of specify because
Yeah.
live audio trading channel.
What's up, man? If you can hear us, how we doing?
Hey, what's up?
Yo, I'm about to throw in the chat check this. I don't know if you saw it, Max, but look at this.
All right.
Oh, it better work. Oh, the bot. Dude, this shit ripped up
Oh,
to
yeah,
$18
I heard all about
or
this.
20 bucks. Isn't that unreal?
Yeah, this is a pure sympathy play. Unbelievable.
Fucking
400%.
yeah, fucking crazy. It's like
Yeah,
APT.
yeah. Um, yeah. Sympathy play. Now let's go ahead and uh, I think we searched it up earlier today, but let's see the float and some other stats on it to get a better idea of why we saw this sympathy play. Because it died out, ABIO died out in volume from, from like 11:30 to 1:30, and then we got a short squeeze surpassing $13.
Yeah. What's going
So
on,
that
man?
$13 was great, great break. Just unfortunately, it didn't have the capital
Yeah.
um, to further support the trade. But it's nor did I have any trades. Keep forgetting about PDT. Hey, oh, he left.
He left.
I was just about to greet him. So, uh, right, Jesus, it's a 1.5 million share float. So, how many shares did they trade today?
Fucking 83 million.
3 million.
That's insane.
Unbelievable.
It's the one that
No
got away.
wonder.
Should have bought and hold all day.
Yeah, yeah, seriously, it really got away from us. Uh,
We played
right,
it
it really
right though.
did. Yeah, yeah.
Shoulda,
Uh,
coulda, woulda. Name of the game.
yeah, shoulda, woulda, coulda. Exactly. All right, I guess
Let's get after
yeah, let's get after it here. Right, so all of the traders out there that just recently joined, I just want to clarify that, uh, you know, this trading room is really going to satisfy not just one, but quite a few things. The first one, obviously, as you could see for yourself, is information and knowledge. These two aspects of general conceptual life is greatly determined in how you trade and your performance in trading as well. Because it really comes down to the type of person that you are in trading. As corny as it may sound, right? But it really does matter as to what kind of person you are. And I've talked about this, most recently actually. And it really comes down to, between two variables. First variable is impulse, right? So how impulsive is somebody to be versus their rationale? Whether that's the other variable, their rationality, whether they are rational or irrational. And so you could kind of create an XY chart with these two variables. And it's actually pretty interesting when you give yourself an honest kind of test of, where your efficient frontier may underline that XY graph. But, anyways, really conceptually speaking, it really comes down to, as a trader, between impulse and rationality. If you can maximize those two variables at once, then you are in the automatic lead. You are ahead of the game. There's a difference between actually being ahead in the game in terms of trading the stock market or options market or whatever market you're really trading in. It's not so much that, but it's more so of how you can actually consistently perform these metrics of performance in terms of, like we said, impulse and rationality. Again, if you can maximize those two variables, and stick alongside with your trading strategy, that may be intraday, it may be a swing strategy, an overnight hold strategy, it might be a momentum breakout strategy. There's many out there that can make you lots of money. Ethan and I, we have developed our own, right, through trial and error, through many, many years of trial and error. And only till recently have we discovered something that works for us. But not only that, something that works for us consistently, right? So it's not and obviously trading strategies themselves are subject to change due to the forever evolving stock market and the participants that are made up of the market, right? For every marginal buyer, there's a marginal seller. So that's very, very important to keep in mind. Right, Ethan, so
Yeah.
did you have any comments about that?
Well, yeah, I mean, obviously it comes down to trial and error and the type of person you are, but at the end of the day, it's really about how much you're willing to work and figure it out and try your best and put your best effort into anything, whether it's
Yeah,
trading or into your life, you know? If you're not willing to put in the work to do what it takes to become profitable or consistently good at anything, you're never going to succeed at it because just like anything else in life, I feel like a lot of people get caught up in they think that trading stocks is like a get rich quick scheme, but it's not. It's a get rich slow, consistently. It takes time, and you got to have a good strategy on top of everything else. So
absolutely.
it's all about working your ass off and trying your best.
Yeah, I'm glad you pointed that out. It is extremely vital to work your ass off because people do, like you were saying, Ethan, people do consider things like day trading and even investing. People will take it to this extreme that it's a form of gambling.
Yeah,
Now, don't get me wrong, in essence, it is gambling. But there's a difference between playing poker or blackjack or backgammon versus, uh, trading stocks,
of
right?
course.
In poker, for example, you do have participants, but those participants are forever evolving in the same simultaneous matter as you are. You just have different metrics. However, in day trading, you're dealing with, again, for an ever evolving market that's comprised of millions and millions and billions and trillions of dollars each and every millisecond of the day in money flow. And speaking of which, as a trader, for example, say I were trading equities, small cap equities with a low float, advantageous volume pop to the upside, and it comes out with a catalyst report, this pre-market, and I see the thing is up already 100% before 9 a.m. Right, so 30 minutes to the bell, the thing's already up 100%. Let's say it has a 5 million share float. So and the short percent interest, prior to the stock's increase of value of 100% was 60%. So the amount of people that are short the stock are actually short 60% of the entire common stock. So what does this tell you? Well, number one, the fact that it's up already 100% before 9 a.m. Okay, the thing is clearly, number one, overextended, and there's over 50. The overall common stock is on the short side, which could mean one of two things. When the stock market opens, when the stock starts trading in market time, it will either contain a short squeeze, right? Because the shorts are going to cover their shares and they'll be forced to buy the stock and thus increase the demand for the stock price to go higher. Or what will most likely happen is a pullback out of the gate, right? Because people are, let's say from 9 to 9:30, we were seeing a little bit of a descending off the pre-market highs. So if we see any form of weakness off a solid trend of 100%, and the market's about to open, and 60% of the shares are short, this ought to tell you to at least remain cautious. So that's just a kind of long example, illustration of why you should also be an extremely cautious person. And that goes in part with your rationality, which we were talking about earlier, right? So for example, I don't know who really traded today, but Ethan and I scored 3 out of 3 trades. 3 wins, which was great. No losses, which is fantastic, right? And how we did that was we scalped, right? We scalped ABIO, which we were just checking at the beginning of this call. It went all the way to, it ended up being up almost 400%, and we got the thing when it was down at
$8. It was like $7.
$7.
We would have made more than $10 a share if we just bought and held all day.
Exactly.
Crazy.
You just bought and held. Now the problem with ABIO that wasn't really indicative is there was no real prehistoric kind of spike like what we saw today, given even its small float. Number two, there's no possible indicative way of determining is this a sympathy play or not. Sympathy plays are based upon the bid getting knocked out, or excuse me, the ask getting knocked out by an overwhelming bid, and this bid was obviously sustainable throughout the entire day. And I did point out that from like 11:30 to like 1:30, which is typically when liquidity and volatility drops, generally speaking, in the stock market, right? Because it's lunchtime, it's stuff like that, lunch meetings, and we saw the same reaction in ABIO. So it was basically consolidating through that lunchtime period, through that period of minimal volume and volatility, and the range was just tightening up. At like 1:30 on the dot, we saw a huge volume bar followed by a huge green candle, right on the price chart, and it just went up with higher lows from there on out. And it's pretty incredible. We traded, like Ethan pointed out, down in the 8s and 9s, which is just incredible range. But to hold a sympathy play is kind of like holding a lottery ticket that doesn't expire.
There's no strategy in it, though.
There would be no reason to. Most traders probably cut out just after 11 a.m. If we take a look at that chart, it's pretty easy to tell in hindsight. But in spite of the moment, that would also be the case. Even 2 red candles down from that 11 a.m. clock, that tick. It just took a break from its momentum into the upside, but really it didn't. It just needed a 2-hour pause, and we saw an immediate move to the upside, which is incredible. By the way, I forgot to put on my video here. So let's kind of paraphrase and in the way that every stock moves for a reason based on just one thing, the spread. The bid-ask spread, which is based entirely on liquidity. Some can argue volatility, right? And a stock that's volatile is supported by its liquidity, and sometimes, usually, vice versa. But what we really need to find out is, how do we find these stocks to trade? What do we do to actually find these stocks? All these people with I don't know if you guys are aware of Trade Ideas, Scan Setup, their software. It's like artificial intelligence trading software, and it's pretty expensive too. But see, I've never really used these kinds of softwares that cost hundreds and hundreds of dollars a month, um, to use daily. Um, I've never used them, and I've never had a problem to find daily high quality A plus setups, um, which obviously is another pointer that you know A plus high quality setup is absolutely vital for every single trade you take. Because if you take anything then less than 100% certainty, you're just asking for a loss, a potential one anyway. The certainty has to be at 100% or higher right here in your brain, before entering the trade. You have to know where you get in, you have to know where you get out, in terms of entry and exit before you enter the trade. You have to know a whole lot. You have to know virtually everything about the trade that you're going to take before actually committing to it, right? Because things can change split seconds, and your entire strategy within a split second can actually change dramatically. And believe it or not, that's extremely essential to being a consistently profitable trader. Right? That's extremely, extremely vital.
Yes.
Um, um, I don't know. I kind of wanted to talk about, uh, unless anyone here has any burning desire questions. You can feel free to cut in. I kind of wanted to talk about what I love to talk about, um, which is not saying I don't love to talk about trading. That's amazing too. Um, but no, I love talking about global macro factors. Right.
Your
Ethan
favorite.
chuckled there. No, yeah. Oh, my computer is. Yeah, I just wanted to talk about uh, some global macro factors because I think it's traders, especially investors, really should not at all uh, be worried some about anything pertaining to the economy in terms of its speculative manner. In other words, I'm saying that you should not even attempt to predict where the stock market is headed because nobody knows. I don't know. You don't know. Nobody knows. The government doesn't. Nobody knows where the stock market is because people think the stock market is the economy, literally. And that is entirely incorrect. The stock market is actually, if anything, an indication of the overall economy. Now, lately, obviously, that's why I wanted to start talking about it. Um, what I just pointed out actually makes absolutely no sense and or correlation to what's currently happening with the COVID-19 crisis, or as I like to call it out, the everything crisis. Right, the everything crisis.
Sucks.
No, and it's because we're seeing the worst. Just to put it bluntly, we're seeing the worst ever in history economic numbers. These metrics are increasingly horrid. Nothing that we've ever seen before on the slightest. And it's relative to the stock market, right? The stock market has retraced almost all of its gains, right? We retrace from the bottom all the way back to the top, all the way almost to record numbers in the stock market to the upside. And some people anyways, scratch their heads in awe and say, okay, so the economy is in the shitter and the stock market is basically at all-time highs. So what is going on here? Save the thoughts. I have the absolute exact answer for you. 2 words: federal government. And followed by that, uh, 4 words following that: artificially low interest rates. Right, artificially low interest rates. The Federal Reserve is keeping interest rates artificially low. And they're doing this because they're trying to accumulate a problem that they've been accumulating and pushing and shrugging off for the better part of 100 years. Right, for the better part of 100 years. And there's no saying to do with this government intervention. that we're seeing, yes, because of them, we saw credit spreads tighten, we saw liquidity start to come back in the bond market right after the initial 2-3 weeks. The stock market was down like 30%. But when the Fed intervened and they started buying up a variety of high yielding debt, um, they actually did provide a form of liquidity to the markets. But guess what? It's a liquidity, it's a liquidity factor based on inflation. Okay, it's based on inflation. So the Fed is literally propping up prices in the stock market, which is exactly what we're seeing now off these lows. This is all the federal government. Okay, because first of all, I don't know a single soul that doesn't think that we are in a horrible economic situation. So what makes you think they're going to put back their entire life savings into something conservative even? Treasuries, okay, aren't not even conservative today. If you look at the 10-year, we went as low as 60 basis points. Okay, what is that? It's a forever derangling cycle that, this is basically a 100-year cycle that is just popping now. The bubble is just starting to deflate now. And how as traders how we evolve through this is, well, to keep a few things in mind, but overall, to literally space it out of your mind. Because macro factors will never, unless you're trading cyclical trade pairs, or if you're cross-hedging with inverse ETFs that represent some kind of index or indice, whatever it may be, that's a little bit of a different story. But if you're trading individual stocks or options, your sole focus should be on that sole security and their metrics, their underlying metrics. Right, so that is also extremely vital to keep all of that in your mind. The macro factors are more for people, again, that especially those that trade commodities, forex, but trading stocks and options, which is what we really tend to focus in this trading room, is not necessarily relevant per se. But anyways, yeah, the economy really, so again, the stock market is showing, like I always say, short-term speculative trend, right? This is a bear market rally. So this bear, and I always say this too, in all bear markets, we tend to see the biggest bear rallies, to the upside. And this is one of them. I just thought it would go a little bit less than it actually did. I thought the stock market would recover a lot less than it is right now. Right, the S&P 500 SPDR ETF is actually trending over 300 and has been for a couple of days now.
Craziness.
Yeah, it's absolute craziness. Right, but the NASDAQ is most outperforming. S&P is a little bit under. Russell 2K, those stocks are still underperforming. A lot of them are at their lows, etc. But we have to understand that when governments are paying 1.5% on their national debt, which just exceeded over $25 trillion, and we're collecting taxation of just $3 trillion, it's just that fact alone demonstrates our government's irresponsibility and their lack of attention to how much chaos and trouble they're causing us. Because, I'll tell you what, this recession is not caused by the coronavirus, it's caused by the Federal Reserve's responses to, and overall government's responses to the COVID crisis, through fiscal stimulus, through monetary stimulus, debt monetization. It's endless list of just disastrous responses to this unfortunate pandemic. And, it shouldn't be any surprise, right? We've seen this in 01, 08, 2011. We saw it in many years prior to this one. So this should not 2020 should not be a surprise. It really shouldn't. But as a trader, Ethan and I, we tend to really, um, trade stocks that are not necessarily trending pre-market. Because a stock, again, like we mentioned earlier in that example, a stock could be up 200% pre-market before even 8 a.m. That's a little bit extreme. That's probably a case of a reverse split, or some kind of buyout at a humongous price, or acquisition. I mean, but no, we trade very originally. This a lot of traders trade is low float, volatile, liquid stocks. It's one thing if it's a low float and it has no volume. That doesn't matter to me. It's not tradable. It's a very simple juxtaposition of metrics between the float, the volume, and the overall liquidity. The overall price action of what the market is giving us. How open will the ask be to my order? Will I be able to get a fast routing order if the trade is liquid enough, right? Because you always want the fastest possible entries and exits in your trades. You have to ensure that. And, I try and refrain away from, stocks trading under $1. Sometimes I don't, unless I see an opportunity that meets my trading criteria, then I'll, probably take it with a low risk, assuming a low risk is taken as well. But usually $1 to $20 a share, $2 to $20 a share is sufficient for us to trade in. Of course, once Ethan and I, start to really generate and accumulate more capital turnover, we'll be able to reinvest at a larger scale, a larger allotment per share. So our share sizes will be much bigger right now. So that'll be great. But for now, we only have $1,500 accounts. So we have to be extremely, extremely careful as well as consistent in delivering consistent returns of our overall portfolio. So we're only trading with 50 to 100, maybe 200 shares if it's under $1 or so, to net a profit here. So it's not like we're making a fortune, right? But we are maintaining consistency, which is extremely, extremely relevant. It's much more important than making a quick dollar in one trade and not actually understanding how you made that quick dollar. Because there is a difference, right? There is a difference between making $1 in the stock market, in the way that your strategy enables you to, and the difference between, that and, being right about the trade, actually making money on the trade, but not really following your trading criteria, not following your strategy. And that could be lethal for the long term, right? For other trades that you're going to take, because you'll be misinterpreted on, the trade you just took, that yes, you did make money in, but you didn't necessarily understand how you made that money. You just got lucky. And you don't want that. You don't want that one bit, right?
Absolutely.
So do I have any questions from anybody? Or shall I keep going? I'll keep going, right? So I kind of crossed a lot of areas here. I crossed trading psychology a bit.
One second, I did have a question real quick.
Yeah, go ahead.
So as you're trading, because I have my portfolio is sitting around 8,000 right now, because I have a lot of long-term investments that I bought bought at the dagger, and I'm just kind of waiting for the investment to pull off so that I can take the large amount of capital and then just have larger trades. That's where I can use that capital to build more. That's
Absolutely.
kind of what my initial plan was, but it's going. But
Okay, so thanks for bringing up the question. Yeah, absolutely. I mean, your overall goal, right? When you put this money to work, when you make this contribution to your portfolio, it's really about compounding your growth. A little fun fact speaking about compounding. Did you know if you double, let's say you started, the beginning of the month with 1 cent, right? And you doubled that 1 cent every single day for 30 days, okay, that comes out to like $10.7 million, believe it or not. But, anyways, that's just good to know. It's a nice little fun fact. It shows you the true power of compound.
Yeah.
But really, if you hold your cash in cash, okay, that's the worst thing you could do. Cash is trash, in my opinion. Because cash is worthless, right? The US dollar is absolutely worthless. It's going to actually, in fact, crash, in my opinion, as well as the bond market and long-term interest rates will take a high spike to the upside, amongst many other disastrous things. But anyways, your number one goal should be, whether, it's a question of conservativeness and aggressiveness. We'll get to that. But for right now, your overall goal should be compounding that growth. Now, let me ask you: are you? Maybe I misheard you. Did you say you were like, you're just starting out with this money? Have you been trading? Because I want to understand from you, if you're more of a speculative kind of trader versus a more conservative one. So if you could let me know there.
mostly just I've had it and then just holding it now, and just trying to. I'm trying to grow into a speculative account.
Great.
Versus conservative. It's more conservative now.
Okay, great. Yeah, so I mean, yeah, trading has a lot to offer, for conservative returns, right? So for low risk, high reward, there are opportunities there. There's a lot of opportunities, and it's quite endless, in fact. Ethan and I find those conservative opportunities every day, right through those three-factor strategies of the low float, high volume, high liquidity factor. That's very vital. But if you really are trying to, my kind of brief suggestion for you is to, for every single trade you attempt, come up with, prior to the trade, a risk-reward ratio, not only one before each trade, but one in general terms that, for example, thus you'll be able to give yourself an average, a goal for every trade you make. So, typically I would always look for at least a 1 to 3 risk reward setup. Some people like 1 to 5, other people like 1 to 10. It really depends on, if you're levered up in margin, that's another story. But if you're just a general cash account, and you want to be on the conservative side, because I don't blame you, by the way. Bear markets actually do, especially recessions/depressions, they do actually have a factor on the price action of the stocks, some of the stocks that you end up trading. That's why, in these depressions, it really does take out on intraday trading in terms of, like I said, the price action, the overall action of the trend in the stock that you're trading. We've seen lately a lot of haltings on the circuit breakers of individual stocks, an overwhelming amount of block trades that are just taking place by the retailers, the retail traders like you and me. And, it's happened in a lot of these cases in a lot of different stocks throughout the duration of this, this unforeseen crisis, right? In terms of the virus. It wasn't unforeseen on the economic side, that's for sure. But anyways, yeah, conservativeness requires a sustainable risk-reward ratio, one that could be sustained consistently, like we were saying. But again, there's so many strategies probably the most aggressive strategy and risky strategy, for example, is what's known as a gap and go strategy. Right, gap and goes, typically you enter at 9:30, 9:30, 30 seconds, or 9:31, and you're basically following the momentum. Let's say it happens to break pre-market highs, right at the opening bell. Let's say 9:30 flat, and it breaks out, and you decide to join in on that buying momentum. You're just risking a fake out, and those fake outs could be lethal, right? Especially the first minute, because you need to give the stock a little time, if it's been trading pre-market especially, to actually settle its ground, to actually let the bid and ask settle the war, right? Because there's always a war between the bid and the ask, right?
Of course.
Right, yeah. So I don't know, does that answer your question a little bit?
Yes.
Yeah.
It does. Appreciate it.
Yeah, absolutely. Yeah, so that's a great question. It's hard to say, because every now and then, every now and then there happens to be, for example, pump and dump schemes, which most of the time you will see on sub penny stocks, or penny stocks, or stocks that are sub one or sub twos. And a good example of this is a stock called INVVY. That's the ticker, and I'm just going to go ahead and type in, just give me a second here. Just bear with me here. Here we go. I'm just going to type in here, let's do, you know what? It might not come up because it's an OTC.
What is that? A little volume index?
Yeah, this is,
I had actually another question.
Yeah, go ahead.
IPOs. I wanted to touch on that, because I actually know very little about IPOs and how to actually manage.
Okay, great.
And buy into an IPO.
Have you had experience with any IPOs?
The only thing I've traded is equity.
Okay, great. Yeah, so I'll give you one example right off the bat. SPCE, Virgin Galactic, and I'm sure you're familiar with them. I know Ethan is, and that's Richard Branson. And basically they went public. Let's just let me just type in the ticker here so everyone's on the same page. SPCE is the ticker. And this went IPO earlier last year, or this year, excuse me. And, it basically IPO'd at around, like $12 or so, and it actually went all the way to 40 in less than a couple weeks, less than a week or so. And my point is, that is the typical behavior of IPOs. Initial public offerings, well, first of all, what they are is when an investment underwriter buys out their common stock and resells it to the open market. Plain and simple, that's all it is. Now, there are different kinds of ways that one can IPO. It could be through a shelf offering. There could be additional kinds of tender offers. There's a lot of ways to actually go public. But the most general way is through a best efforts, what's known as a best efforts system, where the underwriters actually try and sell your shares to the market at the best price possible. And there's a couple other ways to go public, but it's not as common, so it's not really of concern. But if you want to know more, just look that up. But short story short, IPOs, they enable an entity that was previously private to enter the secondary markets, right? The public market, financial markets, stock market, excuse me. And it enables them to actually share, sell pieces of their equity to the public, like you and me. And, so Virgin Galactic actually You're right. I said they went from 12 more or less to more or less $40 in about a week. And like I said, also that's the typical behavior of IPOs out of the gate. Because at the inception of a stock, especially if it's getting hype through channels like CNBC or Bloomberg, etc., if it's getting hype on Twitter even, and you actually see that saturated hype, there is more likely than not that you will see additional volatility at the inception, at the release of this IPO stock, right? And that's kind of what we saw with SPCE. It was all over the headlines every single day. Richard Branson himself, obviously, it was a very hyped up stock, right? But there was a reason for it also, because it was, it made history, right? It's the first ever business to provide commercial spacecraft to the general public, which is really, really amazing. By the way, another amazing thing is Elon Musk's SpaceX accomplished history just the other day, which I put my hat off to Elon Musk, because he is one hell of a guy. It's really someone to look up to. But anyways, that's a perfect example of IPO typical kind of action in terms of price action is Space Galactic. And you could look at other IPOs too, like Box, even Alibaba, Boeing. Go back and see what the average true range was during from the inception of the IPO to say like 2 weeks. And if you really want to get serious about it, if you really want to become a sole IPO trader, which could be extremely profitable, what I would do is go through any kind of hyped up IPO that you can find from the past, comparably analyze all of these IPOs' performances from, like I said, inception to first quartile could be 1 week out, second quartile could be a second week out, etc. 1 month could be the third, whatever, and you'll see something that will indicate something hopefully beneficial for you. Maybe you'll notice kind of trend pertaining to what sector it's released in. Say it's in tech, or there's so many variables that you got to keep in mind while you analyze. It's just incredible. But yeah, IPO trading, it's not something I would personally solely adjust to, right? Because it is extremely risky, because there's no past performance to actually look upon of the stock in terms of its stock price chart, among other metrics. So it's kind of hard to determine, if this thing is in fact going higher, how high could it go? It's kind of important to ask that. And if it wants to go lower, how low can it go? And you really don't know per se, because there's no previous trends of support and resistance to contemplate off different price levels. So I hope I answered that for you, Ethan. If you want to say whatever.
I mean, yeah, you basically hit it on the head perfectly. I mean, there's really no past history to reference anything off of, so kind of going in blind, you just gotta hope that it's. I don't know. I mean, to me, the idea of hopping in an IPO at the IPO price, if you could get in relatively close to it, maybe you could get away with. I don't know. What do you think, Max, would be a rational percentage to try to gain off? Like, something could open up and go up 500%, but at the same time it could go up 10% and then bomb 50%. So, I mean, I don't know. I personally would stay away from them. I just think there's better strategies out there. But
yeah, I agree. There's definitely much better out there.
There's more, put it this way, there's more consistent strategies than shooting in the dark at the IPO,
Yeah.
Maybe you'll get away with quadrupling your money one morning or one day, but I think overall in the long term.
Talk about your strategies. Like I've actually just had like a medium term goal with this, and then I honestly haven't really thought about what I'm going to do with the capital that will actually come of this, because I've been thinking about whether or not to keep it in and look at dividends, or trying to understand how dividends work with either companies based off of the amount of stock held.
Right.
And whether or not to just sell it once it actually hits a previous trend, or because I'm out of right now, I'm sitting at about, bought it at 24 and its trend was 65. Like, that was like 6 months ago, its trend was 65 for like years.
Right.
Yeah, you could see it go back.
Waiting to whether or not to, I mean, it's not going to go up much past that at that point, but I'm still going to hold the stock at that much low of a value and still hold the capital that it built from the recession that just hit.
Right. So, that's great. But let me go ahead and start. Okay, if you really want to get serious about dividends, dividend payments, first be aware that, don't get me wrong, collecting premiums off dividends is the best thing that one can do in the long term. However, I think money is better spent for immediate income, in terms of day trading, right? Instead of, it doesn't sound like, you have $1 million in a retirement portfolio for these kinds of high dividend yielding stocks. Because, there's a lot of companies, a lot amount of companies that actually do pay over 10% yields. But it's not going to help too much because, number one, investors are under double taxation. But that's not to say that you still don't make money. You still make money, but question yourself: do you have a sufficient amount of money to actually generate a sufficient amount of return in the long term with these dividend-paying stocks? It's one thing, again, if you have a whole lot of money, to put away to collect these yields. But if you have under $25,000, basically, if you're under PDT, I really do think money is better spent towards day trading. And so be it if you're a beginner and you don't have a strategy yet. That's what it's all about, creating your own. I'm not done creating my own. My strategy evolves every single day, along with what the market provides for me. But look, don't let me disencourage you here. Dividend-paying stocks are actually, for the most part, there's a difference between a stock that pays a dividend and one that doesn't, but it's actually kind of inversely proportionate because, one company can actually be paying a 10% yield, right? So they're not retaining as much in their bottom line as they could be. Instead, they're giving incentive to each shareholder of, a 10% required return. But if a company is not paying a dividend, for example, right, they have 100% retention, 0% payout, then they are subject to, what one may presume reinvestment to the business. Now it's up to you to decide if you're, is the company actually investing? Are they making acquisitions, merging, whatever? But if they're not paying out to the shareholder, then really all you have for that company is the potential capital gains that you make, which you have to pay, if you're under a year, short-term capital gains tax. If it's longer than a year, you pay long-term capital gains tax, which is actually less than short-term capital gains tax, right? Because the shorter-term trades actually acquire more risk. So that's compensated with the higher yields you must pay. And right, you don't get taxed on your losses per se anyway, right? Because it's capital gains tax. Anyway, yeah, dividends. Excuse me. Short story short, dividends have an underlying value that is in fact a value proposition to the average investor, but again, this is a trading room. I don't know of any traders, including myself, really, that holds dividend-paying stocks almost as a separate line of income. Partly for me because I don't have, a sufficient amount of cash or capital to deploy for this kind of strategy. And also, if the stock actually underperforms and they're paying you a 10% yield, then yeah, you're actually losing less money than you would have without the yield. But it doesn't really matter because that yield is kind of gone in essence if the stock is down so much. So it was kind of a waste of an investment per se. So again, I think under 25 grand, money is better spent through intraday day trading. What I like to do a lot is momentum bias trading, which is very simple. Well, excuse me, let me rephrase that. Not necessarily a momentum bias trader, but a contrarian momentum bias trader. And basically that means, Ethan and I, we buy into the weakness, we sell into the strength. And some problems that we have, some problems that I have, I know, is that and Ethan, hop in after me if you want.
Yeah.
This is important. I think that, with me is that, I have the tendency, the psychological tendency, from Friday after the bell to Monday, all I want to do is trade. Okay, especially while we're all stuck here at home, and we've been stuck at home for a long time. There's only so much one can do. I do preoccupy my time in other stuff that I enjoy, but basically I just urge to trade because I urge making money. I love making money so much. Right? That's why we do this. So,
can't blame you.
I have this exhilaration going in my mind nonstop. And it comes to the point where it's distracting. And, that Monday, I'll be up as early as 4 a.m. just waiting for the first ticks to start popping in front of my screen. Now, it may look as though that's a kind of compulsive, gambler-oriented mindset. In essence, it kind of is. But
You're
that's
addicted.
something I have to control. And I know I have to control because I am, in fact, facing what my problem is. And, I have become better with that tendency to really control my impulse on taking a trade that Monday morning. Right? And, I have been doing better. And it's all about going through trial and error. For every loss, there's a win. And for every win, there's a loss. Trading is a zero-sum game that isn't really justifiable based on your past performance. It's justifiable based on your present, your what's the word I'm looking for? Your present, I guess you could say, correlation to trading.
Yeah.
What you're doing now is what's most important, not what you've been doing or what you're going to do. Right.
You got to learn from every opportunity, whether you win or lose. You have to learn from it. Put it that way. That's the way I take it. And I feel you on that aspect. Oh, first thing I want to mention, we should wrap it up in like 10 minutes for video's sake, so it's not so long. But back to about the, Friday to Monday, we want to trade. Trading is definitely addicting, you could say, or I would say from my own perspective. And you have to kind of, I'll put it this way. When in the beginning, I was very compulsive and got very excited and I wasn't patient. And Max, I've been preaching patience lately and it's been working out a whole lot better. You can't be compulsive in jumping in and Tuesday, Max, I learned something, even though I was able to fucking scale down all the way in and bag a profit out of that trade that we got into pre-market, we were a little compulsive and we were a little bit too eager to get in. And if we had just waited till the bell, we would have saw that it would have fucking broke out of the gate down and then we would have gotten in and we would have both fucking made nice profits and it would have just been a whole different trade, It would have been, we were a little bit compulsive, and even though I made money off the trade, and I don't know, I think you're still holding it, right, Max?
I actually cut my losses today.
Yeah, I mean, it happens, and even though I was able to squeak by and get lucky and milk some profits out of it, I I took away later that day that that was a learning opportunity, that we were a little bit compulsive. We were a little bit too eager after a 3-day weekend to just get into the market. Even though, it wasn't the worst trade we could have hopped into. It was looking pretty juicy. But it goes back to the mentality of like, if we had just been a little more patient, I know you wouldn't have lost any money on that, Max. You know what I mean?
Yeah, for sure.
And I wouldn't have had to execute the way that I had to execute. I wouldn't have had to adapt on the fly. You know what I mean? Our strategy that we've been running lately, it would have worked out almost fucking perfectly if we were just waited 5 minutes after the bell to decide to buy. You know what I mean? And just like you said, you gotta let things sizzle out or settle out.
Exactly.
So
That's a good point.
that's my 2 cents on being rational and irrational and
Yeah, I've definitely had my share of that one.
yeah, you're just too eager. You're just too eager to hop in, and
And then you buy pre-market and you fucking
yeah, you just think, or you buy right at the bell. You buy right at the bell,
Ass by those shorts.
and you just get fucked. You just get absolutely slaughtered, and it takes a couple burns, a couple stings, whatever you want to call them, to figure it out. It's part of the game, and so I look at it as learning opportunity. Whether you win or lose, later in the day, what I've been doing is I've been going and reviewing the trades, whether I won or lost. I go and I look back on it, and I see things that I can do better on, and I can see things where I did good on, and I pat myself in the back and say try to do that next time again. And then I also see shit whether I won or lost, and I'm like, well, don't do that. Like, that was kind of stupid. Even though you made money from it, that wasn't the most patient or conservative way to consistently follow through with the strategy. I don't know.
Yeah. Backtesting is everything.
Yeah, absolutely.
Well, gentlemen, I'm gonna have to head on out. I appreciate the conference call, and I will see you guys next Thursday.
No, I mean, this is gonna take place. We're gonna try and do it like every day or
Yeah,
every other day,
as-
whatever it may be.
as much as we
Sounds
can.
great.
As much as we can. Yeah, we're here to get rich together, right?
Yeah,
All right.
Alright,
All right. Take it easy.
take it
Thank
easy,
you for
man.
that.
as well. Have a good night.
You too.
So I get. Yeah, I mean, we could finish up here, right?
Yeah, I mean, we're at 57 minutes, so I can stop recording now, or we can just wrap it up with if you want to say anything else.
Yeah, I mean, let's just since you were talking about back testing, let's just emphasize how vital that is quickly.
Yeah.
Because, like you said, every single trade that is taken, win or loss, is absolutely a lesson that must be interpreted rationally.
Hmm.
And that rationality does in fact come from hindsight, but it's again back tested based on the trade that you made, not what you could have made. So there is right there a vast difference in a trader that's in denial and a trader that's actually trying to segue into consistent success.
Of course. Yeah, you gotta learn, and that's the thing. You gotta just it's a game. I look at it as a game that's ever evolving, and any second you can get smacked. You can hop in, and an institution can dump a whole bunch of shares, and there you go. You're down 50 cents a share on your $2 stock that you're trying to day trade, and you're like, fuck. Well, what do I do now? And that can happen any second of the day. So it's kind of just, you always need to be learning, and you always need to be prepared for the unexpected. And so yeah, every day later in the day, I've been just going through, and I pull up my Excel spreadsheet, and I look at the record, or I look at the numbers, and I look in Thinkorswim, and I just think about it all, and I think about, okay, one of the trades, I think it was on Tuesday, one of my scalp plays, I was quite disappointed in myself, because when I went back to review it, I scalped it right on a nice kangaroo tail candle, and that thing spiked afterwards. Like, I scalped it right in the candle before it took off. And, coulda, woulda, shoulda. How am I supposed to know, in the moment? But maybe next time, if I see a kangaroo tail like that, I'll be a little bit more confident, or it'll pop into my head. Maybe I'll hold on for more than 10 seconds, or maybe this scalp play can turn a little bit more into something else. Let's see where the momentum takes me. So
Yeah.
it was just a learning opportunity.
Charm, right?
Yeah, even though I made money, I learned that you missed the big signal, that you could have maybe made a little bit more out of it. But also greed is a killer. Greed is a killer.
Absolutely.
Yeah,
Yeah.
we know
We all
that.
fall victim to that one.
We know that.
Um,
So just
all right.
yeah,
So you want to call it?
yeah.
Or-
I'll stop recording now.